Hey guys, and welcome back to our third transactional video dealing with journal entries or transactions that you are going to you're going to see a number of times throughout this course. When you get out in the real world, start doing accounting, you're going to see these transactions. So what I wanted to do again was just to provide you guys with some sort of resource that you can go through and just kind of watch these at your leisure. And hopefully they'll help you not only study, but to really get these debits and credits and analyzing transactions ingrained in your memory. Okay, so real quick, when we finished our last video, I did fail to put in a disclaimer, or not a disclaimer, an explanation here. So basically what happened here was we received customer prepayment. So that's what we're going to say. Received customer prepayment for service. Okay, so now let's go ahead and let's look at another one. Remember, we're always skipping one space in between all our journal entries. Okay, so let's go ahead and look at another transaction, which pretty much takes place in every single business. Provide service to customers for cash. So let's say that on January 7th, Acme Company performed services for a customer and was paid, we'll say $13,510. Okay? So right off the bat, what is happening here? The first thing I need to do is analyze that accounting equation. Well, I received payment, right? And I performed a service. So our stockholders' equity is going to go up. Specifically, our revenue account is going to increase, and we're being paid cash. Cash is an asset, so my asset's going up. So basically, we have an increase in cash and an increase in stockholders' equity, specifically an increase in revenue or service revenue. Okay? So remember, there's three pieces. Every journal entry has at least two accounts. I need to identify those two accounts. I need to identify the dollar amount. And I need to determine which accounts are debited, which accounts are credited. Okay? So, again, just by reading that problem, January 7th, Acme Company performed services. Oh, we perform services. That's our job. Revenue, right? Shareholders' equity got hit. When we analyzed the transaction, we specifically said service revenue, and we received cash. So we already identified our two accounts. Now, how do I journal this, right? So on January 7th, I know that cash was increased. Cash is an asset. I increase an asset with a debit. I decrease an asset with a credit. So cash is going to be debited for $13,510. And my credit is service revenue, right? I already identified that owner's equity, specifically the revenue account, goes up. So I'm going to type in service revenue, and I'm going to credit it for $13,510. Okay. Now, if I am unsure, revenue, does it go up with a credit? Does it go up with a debit? I can't remember. That's okay. Okay, because we're just right now we're starting to learn this. We identified cash as an asset. We know assets increase with a debit. We know that 120%. We know the other piece of this transaction is service revenue. We already have a debit. We absolutely need a credit. We know service revenues hit, so by default, service revenue has to increase by a credit, okay? And then I'm just going to go ahead and italicize for an explanation, and I'm going to say that, well, what happened here? Well, we performed services for cash, right? We got paid. Now, notice I'm running out of room here. Remember what I told you, we have to format everything, right? So I'm going to come down to my last formatted cell, get my little crosshairs, and I'm just going to click and drag so I have more space, okay? So now we're ready to move on to our 8th transaction. Now this is a transaction, again, that all companies at some point in time in their life are going to have, okay? And this transaction is basically providing service for cash as well as on account, okay? So there could be a time where we provide service. Somebody says, I don't have all the cash, okay? I can give you half now, half later. We say, okay, no problem. So here's the example. Okay, on January 8th, Acme Company performed $4,740 of service, of which it or the company received $1,000. Sorry, it received $1,000 cash, with remaining to be paid in the future. Okay? So what's going on here? Well, I need to analyze the transaction, right? Looking at the accounting equation, assets equal liabilities plus owner's equity. Well, my equity's going up, specifically service revenue. Cash is going up. And we have another asset, accounts receivable, is going up. Okay? How do we know we have a receivable? Well, we know we have a receivable because we performed the service. They paid us in cash. Well, they paid us a little bit of cash. And they have an obligation to pay us. We now have a privilege of receiving money or cash for services we provided. So that's an accounts receivable. So how do I book that? Very simple. January 8th, right? What are my debits? Well, I have two assets, cash and accounts receivable. Already identified those two. They are assets. Assets increase with a debit. Assets also decrease with a credit. So I'm going to debit cash for how much? $1,000. And I'm going to debit accounts receivable for the difference, or the remainder, which is $3,740. If you're unsure how I got that, the total service revenue, or the total service that I provided, was worth $4,740. They gave me $1,000 cash. They still owe me $3,740. Okay, so now what I'm going to do is I'm going to enter my credit. Well, I know service revenue went up. Service revenue is part of my owner's equity. Owner's equity increased. So service revenue, or revenue, increases with the credit. So I'm going to type in service revenue. and I'm going to credit it for $4,740. Why? Well, because remember, debits and credits always have to equal, okay? The amount of service that the amount of service revenue that I earned was $4,740, okay? Debits and credits equal, I'm good. So now I can go ahead and put my explanation. Well, what happened here? Well, provided service on account and for cash. Pretty easy, right? Okay. Let's look at another transaction that we could have. We will have it. You will have it in your problems. You will see this either every 2 weeks in the real world if you're working for a company, or possibly every month. If you're lucky, you'll receive it every week. We got to pay our employees. We got to pay them wages. Okay? So here's the transaction on January 9th. Acme Company. Say Acme Company. Paid. Right now. I'm just stopping for a second. Paid. Automatically cashes one account that's going to be hit. Why? Because I saw paid. So on January 9th, Acme Company paid its employees $1,620 cash on completion of their first 2 weeks. Okay, so right off the bat, what's happening? Well, right off the bat, I need to look at my accounting equation, or think about my accounting equations and say, okay, what's going on here, right? Well, paid cash. What's cash? Cash is an asset. So I have an asset going down, and I have stockholders' equity going down. Why? Because I'm spending cash, right? I'm spending cash. What am I getting for that? Well, I'm getting my employees' time and their effort, okay? Specifically within stockholders' equity, excuse me, is our wages expense, okay? So by default, my wages expenses are going to be hit. That is decreasing my shareholders' equity. Remember, all expenses decrease our shareholders' equity or our owner's equity, okay? So let's see what we do here. So on January 9th, we've already identified what's happening, right? And what accounts are going to be hit. I'm going to hit cash, and I'm going to hit wage expenses, okay? Well, what do I debit? What do I credit? Well, I know assets increase with a debit, decrease with a credit. My assets are going down, so I need to credit my cash, okay? Well, if cash is being credited, expenses, specifically wage expense, has to be my debit because I already have my credit to cash. Wage expenses have to be debited. Now, I know that expenses increase with a debit, decrease with a credit, so I'm going to say wage expense debited for how much? Well, $1,620. My credit, which is going to be indented, is cash because it's going down. I decrease an asset with a credit, $1,620. And I need to put in my explanation. Why did I do this transaction? Well, I paid employee wages. Okay? And that, my friends, are the typical 9 transactions that you will almost always see within owner's equity, or I'm sorry, within the accounting records of a business. Okay, and I apologize. We have one more I failed to recognize here, and this is when customers pay us on account. Okay, well, what does that mean? Well, let me give you an example. On January 10th, Acme Company received $2,400 from a customer for services previously performed. Okay? So what this means then is that this customer did not pay us, right? We performed service. We earned the revenue because we provided the service, and payment is, guess what? Pretty much guaranteed, right? Hopefully they have a promise to pay us. So on January 10th, I need to analyze this transaction and book it. Okay, well, what's happening? Well, received $240,000 from a customer. Well, what did we receive? $240,000 cash. So an asset has to increase, right? What happened? Did I provide a service? No, didn't provide a service at this point in time, right? They are paying me back for service that I provided them in the past. So there's a liability out there that they are now satisfying, there's a receivable that we have that they are now satisfying. So they owe us money. They have a liability, right? It's their liability to pay us. We are entitled to our cash or payment. They are now paying us, okay? What do? Well, we have an asset increasing and we have an asset decreasing, okay? What do you mean? Well, what did I get from this transaction? Just read it. Received $2,400 cash from a customer. Okay, cash got to go up. How much? $2,400. What's going down? Well, my receivable, right? I'm receiving that money. I don't have a receivable anymore because it was satisfied. So I'm going to indent my credit because remember, accounts receivable was an asset. Assets decrease with a credit. So I'm going to credit AR for $2,400. I'm going to italicize my explanation and I'm going to say what happened here. Well, received payment on account from customer. Okay? Now that, my friends, is the typical 10 journal entries that every business is going to make, and you will see these from now until the end of your accounting career. Real quick, just as a review, what did we do here? Well, remember, the first one was owner contribution to the company. The second one is that we prepaid for an expense, right? We prepaid our insurance expense. We prepaid our rent expense. We bought something on account. That was the third type of transaction we'll see. Signing a note to get cash. It's the fourth type of transaction you're going to see. Bought equipment. Paid cash for that equipment, right? Always going to see that. We receive we receive prepayment for services. Always going to see that. Remember, we hit our cash because we're receiving cash. We have a liability. That liability to us is to provide that service. So we have an unearned revenue liability. We're always going to see perform service for cash. We're going to see performing services on account, or we're going to see provided services on account and for cash. We're going to see a transaction where we have to pay employee wages, and we're going to see transactions where we receive payment on account from a customer, meaning a customer owes us money, we have a receivable, we acknowledge that we received payment for that receivable, and the receivable is then satisfied. Okay? So I hope this helped you. If not, if it's still as clear as mud, please reach out to me. We can talk about this more. Again, the only way to really get this ingrained in your mind is rote memorization, is thinking about it, because we have to do this in order for us to prepare the financial statements, the income statement, the balance sheet, right? The statement of cash flows, which we'll see later in the course. So there you have it. Again, if you need anything, please feel free to reach out to me.